Hello, I'm Dick.
And I'm Eric, and we're the Annuity guys.
Well, Eric, first of all, we're talking about surrender options.
Now, that's a taboo word in the industry, isn't
Well,
it?
it is. I think it scares a lot of folks about annuities, the idea of surrenders.
Surrender, that's like giving up, It's like
Penalties and surrenders. Right. We're starting off on a very negative note here.
That's right.
But really, it comes down to good planning.
Yes.
And most folks would never need to use surrender options if they do proper planning. Now, even with proper planning, sometimes you actually plan for some surrender options.
Well, as I say, the ideal is to plan without surrender options.
Yes,
but there's just knowing that there are options available should you need to basically move out of a policy and what the ramifications are. If you do have to get out, I think these are key aspects that we kind of want to talk about today.
And I think one of the first ones that most folks are familiar with and maybe need to put it in proper perspective of how to think about it and use it, and that's the free look.
Yeah, and what happens is once you fill out an annuity contract, because you don't actually really see it until such time as it's delivered to you, you have a period to look it over, basically review it, before you're actually having to make a final decision.
Right.
And so you're typically, with almost every state, there's a minimum of at least 10 days.
Yes.
There are a few states that are actually as high as 30 days.
Yeah, and sometimes the companies will actually go beyond what the state says. If it's 10 days, sometimes the companies will give you 20 or 30. And a lot of times folks want to see the contract first before they sign anything. And a lot of times you can't really get an actual fully representative contract. You can get an example contract, and you pretty much have to step into the annuity, get the most current contract that you've signed sent back to you, and then take the time to really study that contract. And that's why they give you that time. Yeah. So you can just clearly say, well, this isn't in my best interest.
Correct. Yeah. So that free look is really that magic undo button. If you want to say, hey, I don't like it, let's roll it all the way back. Give me my money back. Put it back. That's the option.
Well, and we've kidded around, saying this is the money back guarantee, and so, but it truly is. I mean, you get your money back, and it is guaranteed to be what it's supposed to be, or you should not really go through with it.
So so that's one of your first kind of early surrender options. Yes. That's really built into every contract.
Yes.
Now, we've got an instance where we've got MVAs, which are market value adjustments. So you've got a market value adjustment. There are times where you can actually have a positive MVA that could potentially basically offset a surrender charge.
Yes, and folks, just to explain a little bit about the MVA, market value adjustment, not all annuities have market value adjustments. The real reason why insurance companies put market value adjustments on annuities is because they really want that the client to share some of the interest rate risk. So when interest rates are going up, it can actually increase your surrender charges. When interest rates go down, it can, I don't really want to say decrease, but overall it does decrease your surrender charges overall.
Yeah, so it's really a formula. I mean, if you look at it, it's usually stated within the contract of how, depending on where interest rates move, how that MVA formula then impacts your surrender.
Yes.
So it's a way for that insurance company to usually look at a rising rate environment and not to get stuck with having to sell out a lower cost bond at the wrong rate, really.
Exactly. So, and many times you might wonder, well, why does the insurance company put the MVA on? And they do it so that they can be more competitive with their contract. If their clients are sharing some of that interest rate risk that they face, then they can be more generous with the benefits on the annuity. So I guess in summary, there are times in a positive MVA environment where interest rates are decreasing that mathematically that MVA can offset your surrender charges, so it becomes an individual choice. If you need that money, you may actually make money to surrender early. And if the interest rate environment would reverse, then you'd be in a situation where it would go away. You'd never have an opportunity to do that again.
Right, yeah, and it's only there typically for the period of the surrender charge.
Yes.
So after that time, the MVA no longer has any bearing on it.
Right, it never earns interest. It never passes on to heirs. It disappears at the end of the maturity of the annuity. So it's just kind of like this little window of opportunity. You have to be aware of it. And that's where it takes a good advisor. And you do good planning. And
it's understanding exactly how it works.
Right.
So there's times the MVA is good, times the MVA is bad.
Yes, yes. Well, return of premium. This is very interesting because some companies design their annuities to let you walk away.
Yeah, how about that? You got a surrender charge, but we'll give you all your premium back.
Yeah.
Which is it's not available on necessarily every annuity. And some carriers have a charge or a fee for that type of benefit. But what it allows you to do is basically walk away with what you put in. Now, you're not going to get the interest gain potentially. So, but it's 2-3 years in, rather than having a 10% or whatever the number is penalty surrender charge.
Yes,
you could potentially walk away with what you put in.
Well, and there may be a reason why things have changed for you. Maybe the planning wasn't done well, or there were some extenuating circumstances that happened that couldn't be planned for. So it might just make more sense. It could be that you feel that the annuity's underperforming. It's just not doing what you'd hoped it would do. And so you want to just kind of take your marbles and walk away.
Well, and I think kind of one of the places I see it being used as a strategy right now, we're in a low interest rate environment. Let's just throw the facts out there on the table. Right now, as we're filming this, it's a low interest rate. If you want to get into a contract, and it may not be the highest interest rate, you may be getting a 2 or 3% potential gain. You know that 2 or 3 years down the road, if interest rates change, the environment changes.
They take a big jump.
You decide there's not enough potential in this contract. I'm going to take my money. I haven't lost anything, but I'm going to walk away and put that into some other type of plan.
Yes.
If interest rates all of a sudden go bonkers and all of a sudden the rates environment change significantly.
Now, a couple of other things about this, Eric. Now, there's some companies that they don't just give you a return of premium anytime, walk away anytime you want. They actually have a benchmark.
Yeah.
And they say if it performs below this level, you can walk away with your money.
Yeah.
And there's some that actually charge you a fee to be able to walk away without a surrender charge.
Yeah, and the other benchmark that I come and see is insurance companies say that you got these caps and surrender periods. Where we may say we're going to set the low rate at 2%. If we ever have to go below 2%, you can walk away penalty free, which is a way of kind of putting their own guideline out there to say if we ever have to drop rates below a certain level, then we're going to give you a return of premium guarantee.
Eric, number 4 on our list here is the death of a spouse. Now, you really wouldn't think in terms of... folks, we really want to put a disclaimer on this. You don't want to plan, to off your spouse, because you want to get out of an annuity.
That was not the way this is supposed to work. No, it's not part of proper planning is normally.
But what does happen with proper planning is when husband, wife, spousal situation, one is less healthy and knows that their days are numbered.
Right.
Many times there's a choice made in proper planning to let the person that may not live as long buy the annuities, have the annuities in their name, so that there's more options at the point of death for the well spouse.
Right. So, and depending on how the contract is written, some contracts are owner-driven, others are annuitant-driven. You could have an annuitant-driven contract where if you're joint annuitants and one of you passes, at that point in time the contract becomes penalty-free. Now, this is going to differ by carrier and by rules, so you want to know going in if you're joint owners.
Yes.
Do you both have to die for it to become penalty-free, or does one have to pass?
And this takes some more advanced planning and somebody that's very knowledgeable. But really working that aspect into it does give a lot of options and freedom to get out of surrender penalties at maybe an optimal time.
Right, yeah. Although we would say death usually is not something you can plan for, but it is out there. Now,
go ahead.
I was going to say, the last item on the list.
Now, this is the controversial one.
I don't know about this one.
This is going to get us in trouble.
So, the unsuitable sale.
Yeah.
Now, basically, if you've been fudged over,
bamboozled.
If you were sold something and truly didn't understand it at the time it was purchased, or
it wasn't properly explained,
or there was a degree of deception in the sale or something.
Yes.
You have the ability to go to the carrier, to go to regulators, to go to the different bodies and say, hey, you know what? This is not what I thought I was buying.
Didn't fit me. It wasn't explained correctly. And there may be a little tug of war there in terms of, getting fair treatment. But I have seen situations, Eric, myself, repeatedly where someone maybe bought an annuity, they were told maybe perhaps it was a variable annuity, and they were given that it earned a certain rate of return, and it had guarantees, and only to find out that that wasn't really the way it worked, and that their money was at risk, and they were at an age where they didn't want their money at risk. And the companies would allow them to get out of that annuity because it was not properly represented.
Now, there is going to be a degree of onus there on you to basically prove that those pieces, that it wasn't explained. Because I guarantee you, within the contract you sign,
it states
it's all stated in there that,
exactly.
that this is what it was done for. So I would say that's the one that's probably, in my mind,
more controversial.
Of these kind of easy outs. I would say that one's not one that I hope my clients ever ever feel the need, because we're explaining everything just like we are here today.
Right.
But making sure you have all the I's dotted and T's crossed before you commit.
So Eric, we talked about 5 different options. Do you think there might be another option or two out there?
There's a couple more options out there, but
I think proper planning really is the key, though, so that you either plan one of these options specifically into the annuity for a reason, or you plan so that you never have to use these options.
And that's probably the best.
Yes.